The idea was simple. Once boomers started passing down their wealth, young adults would finally get their shot at homeownership. But in 2025, the numbers tell a different story. The homeownership rate for people under 35 has dropped to 36.6%, the lowest it's been in 6 years. Meanwhile, the median age for first-time buyers keeps rising, and home prices have climbed 27% since 2020. Inherited homes aren't flooding the market either. Most end up as rentals or vacation properties, not opportunities for new buyers. I'm going to show you why this so-called wealth transfer never reshaped housing and what you need to watch out for. The Great Wealth Transfer Myth. The idea behind the Great Wealth Transfer was straightforward. As baby boomers aged and passed on their assets, younger generations would finally get access to affordable homes. Economists and policymakers expected a wave of new listings, unlocking opportunities for first-time buyers. But the reality in 2025 is far from that prediction. Instead of a flood, there's been a trickle, and the doors to homeownership remain firmly closed for many. A closer look at the numbers reveals why. A significant share of inherited homes never even reach the open market. Many heirs choose to hold on to these properties, converting them into rentals or vacation homes rather than selling. This decision is often driven by the prospect of steady rental income or the desire to maintain a family legacy. As a result, the supply of homes available to younger buyers stays limited, and the market remains tight. Timing plays a crucial role as well. Most people inherit property much later in life than expected. The median age for receiving a home inheritance has climbed to 42. By that point, many recipients have already established their own households, either renting or buying a smaller property elsewhere. For them, the inherited home is less a lifeline and more an additional asset, something to supplement their wealth, not a first step into homeownership. When inherited homes do go up for sale, the buyers are rarely first-timers. The majority of these properties are sold to existing homeowners, often those looking to expand their portfolios or move up the property ladder. First-time buyers remain a small fraction of these transactions, squeezed out by cash offers and higher borrowing power. The transfer of wealth, rather than opening up the market, simply circulates homes among those who already have real estate holdings. Location is another major factor. Most boomer-owned homes are in suburban neighborhoods built decades ago, often far from city centers, amenities, or the kinds of jobs that attract younger buyers. A recent analysis found that only a small portion of inherited homes are located in areas considered desirable by millennials and Gen Z. The rest are in regions with aging infrastructure and declining school districts, making them less attractive as starter homes. Tax incentives further complicate the picture. Current policies, such as the stepped-up basis rule, allow heirs to avoid capital gains taxes if they keep inherited properties. This encourages families to hold on to homes rather than list them. Other tax mechanisms, like 1031 exchanges, make it easier for property owners to swap one investment property for another without triggering a tax bill, reinforcing the tendency to keep homes in the family or as rentals. The rise of accidental landlords has become a defining trend. Many heirs, uninterested in living in the inherited property, choose to rent it out instead. Property management firms report a surge in clients who have inherited homes but lack the desire or expertise to manage them. This shift has led to a growing pool of rental properties, but not necessarily to better housing options for tenants or would-be buyers. Debt is another hidden obstacle. A significant number of inherited properties come with mortgages, liens, or other financial encumbrances. Many heirs are forced to sell quickly just to clear outstanding debts, and these rushed sales often go to institutional investors who can pay cash and close fast. This process further concentrates housing wealth in the hands of those already well-positioned in the market. The expectation that downsizing boomers would free up starter homes hasn't played out either. Most older homeowners are staying put or moving into high-end senior communities, not releasing affordable homes back into the market. The few who do sell often accept offers from buyers with the most cash on hand, leaving younger, less wealthy buyers at a disadvantage. The result is a housing landscape divided by inheritance and access. Families able to pass down property build lasting wealth, while those without that advantage face even greater barriers. The gap between owners and non-owners has only widened. And as the wealth transfer myth fades, another force has stepped in to shape the market, one that affects every buyer, regardless of age or inheritance. Mortgage rates in 2025, the new normal. Mortgage rates are now the defining factor in the 2025 housing market. The average 30-year fixed rate sits at 6.67%, a level that would have seemed unthinkable just a few years ago. What was once dismissed as a temporary spike has become the new baseline, and the effects are everywhere. For most buyers, especially those entering the market for the first time, the numbers just don't add up. Home prices have not dropped enough to compensate for the higher cost of borrowing, and wages have failed to keep pace. The result is that the average household must now commit 42% of its income to afford the median-priced home, a burden not seen since the 1980s. Consider a typical scenario. A $400,000 mortgage at today's rates requires a monthly payment of about $2,450 before taxes and insurance. To stay within recommended debt-to-income ratios, that means an annual household income of nearly $100,000. But the median income for buyers under 35 is only $72,000. Even with a 10% down payment, now nearly $50,000, monthly payments are $800 higher than they would have been just a few years ago. This gap has created a generation of renters who technically qualify for mortgages, but would have to devote almost all their disposable income just to own. Lenders have responded by tightening their requirements. Higher credit scores and larger down payments are now standard, with the average approved FICO score for conventional loans reaching 753, up significantly from pre-pandemic levels. First-time buyers putting down less than 20% face additional costs, as private mortgage insurance premiums have jumped 35% since 2022. That adds another $200 per month for a typical loan, putting ownership even further out of reach for those without family assistance or existing assets. The Federal Reserve's policy choices continue to weigh heavily on the market. As the Fed lets billions in mortgage-backed securities roll off its balance sheet each month, a major source of liquidity has disappeared. Institutional buyers have moved in to fill the gap, now making up nearly a third of new mortgage originations. These investors can accept thinner margins and offer more aggressive terms to wealthy clients, while individual buyers find themselves pushed further down the list. Regional differences make the situation even more complicated. In cities like Austin and Boise, pandemic-era price surges combined with higher rates have slashed purchasing power by more than half. A household that once qualified for a $500,000 mortgage at 3% now only qualifies for $320,000. Meanwhile, buyers in high-cost markets like New York or San Francisco face effective rates well above the national average, especially for larger loans. The national numbers can be misleading, masking just how severe the affordability crisis has become in certain areas. Refinancing has nearly vanished, with only 3% of outstanding mortgages refinanced last year compared to 15% during the 2020 boom. Most homeowners locked in sub-4% rates and have no reason to move or sell. This has frozen inventory, with existing homes staying off the market and new construction focused on luxury units. Starter homes make up just 18% of new builds, less than half the share from the 1980s. Since building for wealthier buyers makes more sense when financing costs are high, renters are caught in a parallel trap. Average rents have risen 31% since 2020, leaving the typical tenant spending over a third of their income on housing. Saving for a down payment has become nearly impossible, and high rent payments are now seen as a risk factor by lenders. In some cities, renting a modest apartment costs almost as much as a mortgage, but the barriers to ownership remain insurmountable. Inheritance has not provided much relief. Heirs often can't qualify for loans to renovate or maintain inherited homes. So many are forced to sell quickly to investors. This accelerates wealth concentration, as more properties end up in the hands of institutional buyers instead of families. Programs meant to help first-time buyers have failed to keep up. Income limits and down payment assistance amounts are out of step with today's prices. And even targeted programs for teachers or first responders do little to reduce monthly payments at current rates. The systems designed to promote ownership now serve mainly those already close to qualifying. Mortgage rates have not just changed the math, they have changed the entire structure of the market. The biggest obstacle for buyers is no longer just the price of a home or the size of a down payment. The real challenge is that so many homes never even reach the market at all. The boomer retention problem. A major force shaping today's housing market is the decision by baby boomers to remain in their homes well past retirement. This isn't just a matter of personal preference. It's a structural shift with far-reaching consequences for everyone trying to buy. In 2025, the proportion of boomers aging in place has reached an all-time high. Compared to previous generations, far fewer are downsizing or moving to retirement communities. Instead, they're holding on to the same homes they've lived in for decades, creating a bottleneck in the supply of available properties. Several factors drive this retention problem. For many boomers, the financial logic is straightforward. Nearly 60% of them have mortgages with rates below 4%, often locked in during the low-rate era of the early 2020s. Trading that for a new loan at today's much higher rates would mean hundreds or even thousands more in monthly payments, an expense that doesn't make sense for retirees living on fixed incomes. Even those who own their homes outright face financial disincentives to move. In states with property tax freezes for older residents, selling and relocating could mean losing those protections and facing dramatically higher tax bills. Physical and emotional barriers also play a major role. Most boomer-owned homes were never designed with aging in mind. Only a small fraction have accessibility features like step-free entries or single-level living. Retrofitting these homes is expensive, but so is moving into assisted living, costs that now exceed $75,000 a year in many places. Instead, families often opt for smaller-scale home modifications and piecemeal in-home care, patching together solutions that allow seniors to stay put. This keeps homes off the market for longer than any previous generation. The emotional attachment to their homes cannot be underestimated. Many boomers see their homes as the place where their lives have unfolded, filled with decades of memories. This sentimentality makes leaving difficult, even if the home no longer fits their needs. In many suburban neighborhoods built in the 1970s and 1980s, residents have now lived in the same house for 25 years or more. These communities have become stable enclaves, with turnover rates at historic lows and little incentive for owners to sell. The effects ripple outward. The homes that boomers hold onto are often the very properties that would have served as starter homes for younger families. Instead, these houses remain occupied, reducing housing turnover and limiting the options for people trying to enter the market. In 1990, seniors made up about a quarter of owner-occupied households. Now that share has climbed above a third, shifting the demographic makeup of entire neighborhoods and school districts. When these homes do eventually change hands, it's often not through a sale on the open market. Increasingly, heirs inherit the properties and choose to hold on to them as rental units or vacation homes. This trend has created a growing stock of single-family rentals scattered across suburbs, homes that would otherwise be available for purchase. Property management companies have made it easier than ever for inheritors to keep these homes as investment properties, further reducing the number of listings for first-time buyers. Municipalities are feeling the pressure as well. Aging in-place concentrations put new demands on local services, from emergency medical calls to infrastructure maintenance. At the same time, school enrollment drops as fewer young families move in, but the need to maintain schools and other public facilities remains. The fiscal burden shifts toward younger residents, who face higher taxes and fewer public resources. Advances in medical technology and in-home care have only deepened the retention problem. Telehealth, remote monitoring, and home-based healthcare have made it possible for seniors to manage complex medical needs without leaving their homes. These improvements extend the time boomers can stay put, delaying the point at which homes return to the market. The result is a housing market where the usual cycle of turnover has stalled. For would-be buyers, especially younger ones, the scarcity of available homes is only part of the challenge. Even when a property does come up for sale, the hurdles to ownership have grown higher than ever. Down payment realities. Down payments now define the reality of buying a home in 2025. The average first-time buyer must bring 12% to the table, nearly double what was required just a few years ago. For the median-priced home, at $416,900, that's $50,028 in cash up front. For a typical 30-year-old earning $72,000 a year, saving that amount under current conditions takes nearly 9 years. And the target keeps moving. Home prices have risen 27% since 2020, and while buyers are saving, the cost of entry keeps climbing. The longer it takes to save, the further out of reach the goal becomes. Lenders are not easing the path. Since the sharp corrections in some markets after 2023, banks have tightened standards, treating large down payments as a buffer against volatility. Any conventional loan application with less than 10% down now triggers additional scrutiny. This shift has cut approval rates for first-time buyers by more than 20% compared to repeat buyers with similar credit. Automated underwriting systems are programmed to flag low down payments as higher risk, creating a cycle where fewer approvals reinforce even stricter standards. The generational divide is clear. Older millennials, now in their late 30s and early 40s, managed average down payments of 13% in 2025, while younger buyers put down only 10%. This difference tracks with career stage and income, but even for those at their earning peak, the financial strain is obvious. Surveys show 38% of young buyers now name down payment savings as their biggest obstacle, a sharp rise from previous years. It's not a matter of poor saving habits. Home prices are simply outpacing what most people can reasonably set aside. Government support hasn't bridged the gap. While some programs in Canada have raised insured mortgage limits, U.S. assistance remains capped by conventional loan limits. In high-cost cities like Los Angeles, a starter home often exceeds these caps, forcing buyers to either bring much more cash or turn to riskier loans. State-level aid rarely covers even half the required down payment. These shortfalls mean that buyers in expensive markets face the steepest barriers, with few viable workarounds. The math behind saving is relentless. Even if a household could save $800 a month after rent and expenses, a stretch for most, the process would take over 5 years, during which time both rents and home prices continue to rise. Many buyers report cutting back on essentials, delaying healthcare, or taking on second jobs just to scrape together enough for a down payment. In 2025, nearly 7 out of 10 successful first-time buyers reported making significant financial sacrifices to reach the starting line. Those who already own homes play by different rules. The average down payment for repeat buyers sits at 19%, but the important detail is that most leverage equity from their previous homes. Selling a property with built-up equity allows these buyers to make large down payments on more expensive homes, reinforcing a cycle where existing owners move up while newcomers face steeper odds. Renters, by contrast, start from scratch and compete with buyers who have a head start. Regional differences make the challenge even more pronounced. In cities like Seattle, the median home price now demands a down payment that exceeds the annual income of most local renters. Even for dual-income households saving aggressively, the timeline to reach that target stretches into nearly a decade. In other markets, private mortgage insurance costs eat away at any advantage of a smaller down payment, adding hundreds to monthly payments and pushing ownership further out of reach. The way down payments are treated by lenders also shapes outcomes. Automated systems often favor buyers who can show a lump sum, even if it comes from a parental gift, over those who have steadily saved while paying high rents. Loans from retirement accounts count against debt-to-income ratios, while family gifts do not, further skewing the process toward those with existing wealth. The psychological effect is hard to ignore. Most millennials haven't even started saving for a down payment. Not because they're unwilling, but because the numbers don't add up. When the path to ownership looks impossible, many simply opt out. The down payment has become more than a financial hurdle. It now serves as a dividing line, shaping who gets to build wealth through real estate and who is left waiting for a break that may never come. The inheritance lottery. For those hoping a family windfall would finally unlock the door to homeownership, the reality of the inheritance lottery is far less promising. In 2025, only a small fraction of millennials and Gen Z report receiving any property from relatives. Even when inheritances do occur, the benefits are concentrated among families who are already well off. The anticipated broad transfer of wealth has instead become a mechanism for reinforcing existing financial divides. Inherited properties often fail to deliver the advantages younger generations need. Many of these homes are located in areas with stagnant job growth or limited amenities, places that don't match where most young adults want or need to live. When inheritors receive a home in a declining region, they face tough decisions. Hold on to a property that may lose value or sell quickly, often to investors at a discount. The chance to use an inheritance as a springboard into a desirable market is rare. For most, the windfall is either an anchor or a fleeting opportunity, not a solution to the housing dilemma. A growing share of inherited homes never reach the open market. In 2025, 65% of inherited properties kept within families are converted into rentals, the highest rate ever recorded. This shift is rarely a matter of choice. Many heirs become landlords by default, lacking the resources or desire to occupy or renovate the property. The rental income often barely covers upkeep and taxes, but the alternative, selling, can trigger tax consequences or family disputes. As more inherited homes become rentals, the supply of homes available to first-time buyers shrinks further, intensifying competition and driving up rents. Vacation homes are another outcome. About 35% of inherited primary residences are now held as second homes or seasonal properties, especially in regions with tax advantages. These homes sit empty for much of the year, removing them from the local housing pool and contributing to affordability problems in both tourist destinations and quiet suburbs. This ghost inventory accumulates, making it harder for new families to find homes in areas with already limited supply. The timing of inheritance rarely aligns with financial readiness. Student debt remains a significant burden, with 2025 graduates carrying an average of $32,000 in loans. For many, the window when an inheritance might help with buying a home closes before they can realistically qualify for a mortgage. Lenders routinely deny applications from heirs who lack the income or credit profile to take on additional debt, forcing rapid sales to institutional buyers. These transactions rarely result in the kind of wealth building that inheritance was supposed to provide. Tax policy and family structure further complicate the picture. Couples inheriting property can avoid capital gains taxes under current rules, but single heirs or groups of siblings often face logistical and financial obstacles. Disagreements over what to do with a property can lead to quick sales at below-market prices. Meanwhile, the wealthiest families use estate planning tools to keep homes in trusts for decades, locking up assets and ensuring their children maintain a real estate advantage long into the future. For most, however, the process is marked by uncertainty and limited options. Banking requirements add another layer of difficulty. Mortgages on inherited homes often require substantial cash reserves, a hurdle that only a minority of heirs can clear without liquidating other assets. Private wealth clients, by contrast, can access favorable loan terms using investment accounts as collateral, further deepening the gap between those with generational wealth and those without. Even when inheritors want to use the property, practical barriers remain. Many inherited homes need significant repairs, on average, $28,000 worth, before they can be lived in or rented. Infrastructure limitations like poor broadband access or outdated utilities make some properties all but unusable for modern work or family life. The asset on paper becomes a liability in practice. The promise of inheritance as a great equalizer has faded. Instead, the process has become another filter, sorting those who already have resources from those who do not. And as more heirs look for quick solutions, a new set of buyers has emerged. Ones who are ready to move before a home ever reaches the public market. Corporate buyers 2.0. Institutional buyers have quietly become the dominant force in the market for inherited homes. Rather than waiting for properties to be listed, they now use probate wholesalers to acquire estates directly from heirs, often before a family even considers traditional selling options. By leveraging data on property ownership and demographic trends, these firms identify likely inheritances and move quickly, offering cash deals that close in weeks. For many families facing urgent expenses or the complexities of probate, the immediate payout is hard to refuse, even if it means accepting a lower price. This approach has created a parallel real estate system. In 2025, nearly 1 in 5 inherited homes changes hands through these off-market channels, up sharply from just a few years ago. Probate wholesalers work closely with estate attorneys and monitor filings to make offers before homes reach the MLS. Most of these properties are never publicly listed. Instead, they are funneled directly into the portfolios of institutional investors. The majority are converted into rental units, bypassing the pool of individual buyers entirely. The financial advantage for corporate buyers is built into the process. They routinely purchase homes at a discount, targeting heirs who lack the resources to maintain or renovate a property, or who face mounting tax and debt pressures. Algorithms flag high-probability sellers, families with multiple inheritors, properties with liens, or homes in less desirable neighborhoods. Individual buyers, constrained by slower financing and less information, rarely have the chance to compete on speed or certainty. The surge in reverse mortgages among older homeowners has only increased this trend. With more properties encumbered by debt at the time of inheritance, heirs are often motivated to sell quickly to avoid foreclosure or further financial complications. Institutional buyers, with dedicated capital and experience resolving liens, are well positioned to step in. The result is that a growing share of inherited homes are sold within months, often at a steep discount and with little transparency. Geography plays a role, too. Corporate buyers concentrate their efforts in areas with high numbers of aging residents, especially in the Sun Belt and established retirement communities. In these regions, the share of inherited homes sold off-market is even higher. The homes themselves often fit the profile of what first-time buyers need: modest, single-family units in stable neighborhoods. Once these houses are absorbed into institutional rental portfolios, they rarely return to the market for individual purchase. Tax strategies further entrench this system. Institutional investors frequently use 1031 exchanges to roll discounted inherited homes into larger, more lucrative properties, compounding their advantage. Each transaction moves housing wealth further away from entry-level buyers and consolidates ownership among a shrinking pool of corporate landlords. Heirs, unfamiliar with the tax and legal complexities, often accept the first offer they receive, unaware of other options or the long-term implications. Technology has accelerated the shift. Probate wholesalers use automated alerts, AI-driven predictions, and direct outreach to identify and approach heirs before most realtors are even aware a property is available. This speed, combined with bulk financing at favorable rates, gives institutional buyers a permanent edge. Individual buyers, facing stricter lending standards and higher rates, are left out of the process entirely. The cumulative effect is a shrinking pool of homes available for purchase by individuals. Each property transferred to a corporate portfolio represents a lost opportunity for someone hoping to build wealth through homeownership. The market for inherited homes has become a closed loop, where properties move seamlessly from one institutional owner to the next, rarely making their way back to families. This shift in ownership patterns is reshaping neighborhoods and altering the trajectory of generational wealth. The consequences extend beyond just rising prices. They change who has access to stable housing and who can participate in the long-term benefits of ownership. as more inherited homes are redirected into the hands of corporate landlords. Rental trap. The
pattern
impact
of
on the broader
housing
housing
market
converted into
becomes
rentals
harder to
has
ignore.
quietly reshaped the housing landscape. In 2025, about 2/3 of inherited properties end up as rental units, nearly double the share from a decade ago. This isn't just a personal choice for most heirs. Tax incentives, straightforward rental financing, and the rise of property management services make it much easier to hold onto a house and rent it out than to sell. For many, becoming a landlord is an unintended consequence of inheritance, not a deliberate strategy. The financial calculations are hard to ignore. Selling an inherited home can mean tens of thousands lost to transaction fees and taxes. By comparison, holding on to the property as a rental can bring in steady monthly income with minimal effort, especially when a management company handles the details. In 2025, property management firms added over 140,000 new accidental landlords to their books. People who never planned to own rental property, but found themselves responsible for homes that could have gone to buyers. This shift has removed a significant share of potential starter homes from the market. Each inherited property turned rental tightens the market for young families looking to buy. The fewer homes available for purchase, the more people remain renters. This drives up demand for rentals, which in turn makes inherited homes even more attractive as income properties. In regions where this cycle is most pronounced, rents have risen over 20% faster than in markets where heirs are more likely to sell. The feedback loop is clear. Fewer homes for sale push more people into renting, which justifies keeping even more homes off the market. The rental trap doesn't just affect would-be buyers. Many inheritors would prefer to sell but face barriers, capital gains tax exposure, expensive repairs, or the inability to qualify for a new mortgage at today's rates. As a result, they hold on to properties they never wanted, often renting them out simply because the alternatives are worse. According to recent surveys, more than 1/3 of accidental landlords would sell if market conditions improved, but for now, they remain stuck. For renters, the consequences are even more direct. The cost of renting has climbed to the point where many pay nearly as much in rent each month as they would on a mortgage, if they could qualify for one. But renting offers no path to equity, and inherited rentals are among the least stable. Individual landlords can decide to sell at any time, and eviction rates for inherited properties have risen as heirs cash out during financial stress or family disputes. Maintenance often suffers as well, since many accidental landlords lack experience or live far from the property. Emergency repairs are common, and renters face disruptions that professional landlords are better equipped to handle. Some regions feel the effects more acutely. In cities with aging populations and declining job prospects, inherited rentals have become the dominant form of housing. These neighborhoods see higher rates of code violations and deferred maintenance, as owners lack both the incentive and resources to invest in improvements. The properties remain just profitable enough to keep, but not valuable enough to attract new buyers, creating a slow decline that drags down entire communities. The financial sector has adapted quickly. Lenders now offer loans that let heirs borrow against projected rental income, and insurance companies package policies tailored to accidental landlords. Even tax software includes features to help track depreciation on inherited properties. These services make it easier than ever to keep homes as rentals, further reducing the number of homes that return to the ownership market. The divide between those who inherit property and those who do not continues to grow. Young adults with inherited homes can avoid rent entirely or use rental income to build wealth. Those without this advantage pay rising rents, often to peers who became landlords by accident. Recent studies show that families who inherit even a single property accumulate far more wealth by middle age than those who do not, primarily by avoiding rent and benefiting from appreciation. Attempts to address the issue have had little effect. Policy measures aimed at encouraging the sale of inherited homes or protecting renters have faced legal and practical hurdles. With most inherited properties staying in the rental pool, the cycle of limited ownership opportunities and rising rents shows little sign of slowing. This dynamic is changing the timeline for when and if people can buy their first home. The path to ownership now stretches much further into adulthood than it did for previous generations, with long-term consequences for families and communities alike. The 42-year-old first-time buyer. The profile of the first-time homebuyer has shifted in ways that would have seemed unlikely a generation ago. By 2025, the median age for entering the housing market has climbed to 38, nearly a decade older than the typical buyer in the 1980s. The reasons for this shift are clear. High prices, stricter lending standards, and stagnant wages have combined with elevated mortgage rates to make homeownership a milestone that arrives much later in life, if at all. For buyers without family assistance, the financial barriers are steep. The median first-time buyer now earns $105,000, a figure that has risen sharply in just a few years. Yet, even with higher incomes, the average down payment has grown to 12% of the purchase price, amounting to more than $50,000 on a median-priced home. Many buyers spend close to a decade saving, only to find that home prices have risen faster than their ability to accumulate cash. Among millennials, the majority have not even started saving for a down payment, and those who do often find that the goalposts keep moving further away. Those who do receive help from family don't always fare much better. The median age for inheritance-assisted buyers is still well into the 30s, years behind the timeline their parents followed. In practice, the housing market has become a test of patience and persistence, with the greatest rewards reserved for those who can wait the longest or draw on family wealth. The result is a growing gap between those who can leverage intergenerational support and those who must navigate the process alone. The consequences of delayed homeownership ripple outward. Family formation is one of the first casualties. Data show that individuals who own homes before age 35 are more likely to have children and start families earlier, while renters and late buyers postpone these decisions or forego them entirely. The cost of housing competes directly with other major life expenses, from fertility treatments to childcare. Many couples must choose between saving for a home and starting a family, and the financial math rarely works in their favor. Local economies also feel the effects. First-time homeowners traditionally drive spending on renovations, appliances, and local services. When home buying is delayed until middle age, this spending is compressed into a shorter window, reducing the economic boost that younger buyers once provided to small businesses and local tax bases. Municipal budgets built around property taxes and school funding face new pressures as the timing and volume of new homeowners shift. The employment landscape has adjusted in response. Younger workers remain in urban rentals longer, delaying moves to the suburbs. This keeps demand high for city transit and rental housing, while suburban communities adapt by building smaller homes and age-restricted developments. The typical starter home has shrunk in size, not just for affordability, but because the new first-time buyer is often older, with different needs and expectations. Student debt remains a persistent obstacle. Even with some forgiveness measures, many graduates carry balances that consume a significant share of take-home pay. Lenders factor these debts into mortgage calculations, limiting what buyers can afford and extending the timeline to ownership. At the same time, older first-time buyers must balance mortgage payments with retirement savings and rising healthcare costs, forcing difficult trade-offs that previous generations did not face. The psychological and health impacts of delayed homeownership are measurable. Renters in their late 30s and 40s report higher levels of financial stress and instability than homeowners. When individuals finally buy in their late 30s or early 40s, they often take on 30-year mortgages that will extend well into retirement, increasing the risk of carrying debt into old age. The relief of finally owning a home is tempered by the reality of long-term financial obligations. For those who manage to buy, the opportunity to build wealth through home equity arrives later and with less time to compound. Earlier buyers benefited from decades of appreciation and the ability to help their own children enter the market. Today's first-time buyers start from scratch, with fewer years to accumulate equity and less ability to support the next generation. These shifts in the age and profile of the first-time buyer are not isolated. They are connected to broader changes in how wealth is built and transferred. As homeownership becomes less accessible and more delayed, the financial strategies of older homeowners and the legacy of property wealth take on new importance. The reverse mortgage surge. Reverse mortgages have become a defining feature of the housing landscape for older homeowners. By 2025, these loans make up nearly 1/5 of all senior-held mortgage debt, a sharp increase from just 5 years prior. What began as a niche retirement product has become a financial necessity for many, driven by rising living expenses, healthcare costs, and the desire to remain in familiar homes. More than 40% of borrowers now use reverse mortgage funds for essentials like groceries and utilities, not just discretionary spending or travel. For heirs, the most common inheritance is no longer a debt-free house, but a property saddled with a substantial lien. The average reverse mortgaged home carries a balance of $182,000 at the time of inheritance, and 62% of homes going through probate now have an outstanding reverse mortgage. The terms of these loans are strict. Repayment is due in full within a year of the borrower's death. This leaves inheritors with little time to navigate probate or market the property, especially when the average court process stretches well over 9 months. Each month that passes, the loan balance increases at an average interest rate of 6.8%, quickly eating into any remaining equity. The pressure to sell quickly is compounded by the realities of the current housing market. Lenders often offer below-market bids, knowing that heirs are under a deadline. Properties with reverse mortgages typically sell for about 11% less than comparable homes without debt, a difference that can wipe out what little value remains for the family. Institutional buyers dominate these transactions, as only a small fraction of heirs can qualify for a new mortgage to pay off the loan and keep the property. Most sales happen within 6 months, and nearly 4 out of 5 reverse mortgaged homes end up in the hands of investors rather than staying within the family. A major driver of this trend is the soaring cost of elder care. Nursing homes and assisted living facilities now consume nearly all the value of a median home within just a few years. Reverse mortgages bridge the gap for seniors who are asset-rich but income-poor, allowing them to access home equity without selling. However, by the time the property is passed on, much of its value has already been spent on care. Heirs are left with little more than a bill and a house that may need significant repairs. 35% of these homes require over $25,000 in work before they can be sold. Tax policies contribute to the problem. In states like Florida and Texas, reverse mortgage proceeds are excluded from income calculations for Medicaid eligibility, encouraging seniors to borrow against their homes to qualify for aid. This creates a situation where both the healthcare system and lenders draw from the same pool of home equity, reducing what is left for the next generation. Public records show that Medicaid estate recovery claims overlap with reverse mortgage balances in nearly 40% of inherited properties, further diminishing the potential for family wealth transfer. The administrative burden falls heavily on heirs. Most are unprepared for the complexity of settling a reverse mortgaged estate, with only a small minority receiving clear instructions from the original borrower. Delays and confusion are common, leading to a growing number of foreclosure filings and extended closing timelines. Title companies report that probate complications alone can add months to the process, while the accruing interest steadily erodes any remaining equity. Physical neglect is another consequence. Seniors relying on reverse mortgages often defer maintenance, unable to afford necessary repairs. By the time heirs take possession, properties are more likely to have code violations or require expensive renovations. These added costs push many families to accept quick offers from cash buyers who can absorb the risk and front the repair bills. As reverse mortgages become more common, the pattern is set to continue. Approval times have shortened, and marketing now targets younger retirees, extending the reach of these loans. The outcome is a cycle in which more properties pass from one generation to the next already leveraged, with little chance for heirs to build wealth or keep homes in the family. This shift in how homes are financed and inherited doesn't just affect individual families. It shapes the broader patterns of who owns property, who accumulates wealth, and who is left out. The next layer of the housing market is increasingly defined by those with the resources and strategies to treat real estate as a long-term, multi-generational asset, leaving most buyers to compete for what remains. The family office effect. The rise of the family office in real estate has fundamentally altered how property changes hands and who gets to participate in ownership. Wealthy families now manage their holdings like small investment firms, blending inherited homes with targeted new purchases. These portfolios are designed for stability and growth, not for use as primary residences. The average family office has expanded its real estate assets by more than 20% since 2020, and inherited properties make up the majority of these holdings, often converted into long-term rentals. For these families, homes are no longer just shelter, they're tools for preserving and growing wealth across generations. The process is systematic. When a family inherits several properties, they rarely consider selling. Instead, the homes are placed in trusts managed by family offices, which then use rental income to secure low-interest loans. With this leverage, they acquire additional properties, usually those that complement their existing portfolio, such as distressed homes near their current assets. Over time, these holdings appreciate, and the family office uses tax strategies like 1031 exchanges and stepped-up basis rules to avoid capital gains taxes. This approach keeps homes out of the traditional for-sale market, reducing the pool of available inventory for buyers. Family offices have adopted tactics once reserved for private equity. They often purchase homes in bulk, renovate them for increased value, and refinance to extract more capital while holding onto the properties. Reports from 2025 show that family offices now account for nearly a fifth of all off-market residential transactions, up significantly in just 5 years. Their focus is on middle-market homes in stable neighborhoods, the same homes that first-time buyers typically seek. As a result, the competition for these properties is skewed, with family offices able to outbid individuals and keep homes within their networks. Trust structures are central to this strategy. High-net-worth families increasingly use dynasty trusts to lock up real estate for decades, skipping generations and preventing heirs from selling. A property inherited by a 25-year-old might remain inaccessible until they reach their mid-50s. These trusts now control a notable share of single-family rentals, and their terms often prohibit sales regardless of market conditions. This creates a persistent shortage of available homes, particularly in desirable areas, and cements wealth within a small group of families. Tax policy plays a significant role in reinforcing these patterns. The step-up basis eliminates capital gains taxes for heirs, while 1031 exchanges allow properties to be swapped indefinitely without triggering a tax bill. Homestead exemptions in some states further reduce holding costs for these families. In contrast, regular buyers face taxes on any gains and higher transaction costs, making it harder to compete. The system effectively rewards those who can hold assets for the long term, encouraging the continued concentration of real estate wealth. The influence of family offices extends beyond ownership. Neighborhoods with high concentrations of family office properties see slower turnover and less community engagement. New business formation lags, and local schools experience enrollment declines as fewer young families are able to move in. Maintenance standards often slip, since absentee ownership and legal protections shield these properties from code enforcement. Rental tenants face longer wait times for repairs and less accountability from landlords, who operate behind layers of management companies and legal entities. Individual buyers are at a disadvantage. While a typical homebuyer faces higher interest rates and strict underwriting, family offices access lower-cost portfolio loans secured by their assets. When market conditions change, they can simply pause acquisitions and rely on rental income, while ordinary buyers have no such flexibility. In competitive bidding situations, family offices win more than half the time, according to recent market data. This approach to real estate creates geographic concentrations of ownership. In some suburbs, a single extended family's trusts and LLCs control more than a quarter of all homes. These neighborhoods rarely see properties listed for sale, and the absence of turnover leads to declining school populations and stagnant local economies. The homes themselves appreciate steadily, compounding wealth for the families that control them, while locking others out of the market. The long-term result is a housing market divided by access to family office strategies. These portfolios are built to last for generations, with little incentive to sell or release properties back into circulation. For most buyers, the homes they hope to purchase are quietly absorbed into structures designed to keep them off the open market for decades. This is just one way housing inventory disappears from public reach, but there are others, some of them even more subtle. The vacation home loophole. The conversion of inherited homes into vacation properties has become a defining feature of the current housing landscape. In 2025, About 35% of inherited primary residences are being turned into vacation homes, a shift driven less by lifestyle and more by tax incentives and financial planning. For inheritors, the logic is straightforward. Keeping a property as a secondary residence allows them to sidestep capital gains taxes that would apply if they sold, while offering the option to generate rental income on the side. The effect is a steady siphoning of housing stock from local markets, especially in coastal regions and popular resort areas. Communities along the coast and in scenic destinations are feeling the consequences. In towns where vacation homes now make up a quarter or more of the local housing inventory, entire neighborhoods sit empty for much of the year. These homes are owned by inheritors who visit only a few times annually, leaving streets quiet and schools with shrinking enrollments. Housing that once served as the backbone for year-round families is now locked away, unavailable to those who might otherwise put down roots. Local workers, teachers, nurses, restaurant staff find themselves commuting long distances or squeezed into makeshift rentals, while houses sit dark through the off-season. The tax code is a major driver behind this trend. Step-up and basis rules reset the property's value at inheritance, erasing years of potential capital gains. Inheritors can hold onto a home, claim mortgage interest deductions, and write off expenses tied to short-term rentals, all while avoiding the tax bill that would come from selling. In states like Florida, assessment caps on non-primary residences further limit annual property tax increases, making it even more attractive to keep inherited homes as vacation properties. For many, the math is simple. A modest property tax bill is easily covered by a handful of short-term rentals, and the property itself can be passed down again, keeping it out of the open market for another generation. This dynamic is not limited to a handful of wealthy families. The majority of vacation home conversions occur among inheritors who already own at least one other property. The median recipient of an inherited vacation home reports a household income well above $300,000 and typically holds multiple real estate assets. For these families, the newly inherited home becomes another investment tool, not a solution to their own housing needs. Meanwhile, only a small minority of inheritors with incomes under $100,000 gain access to these properties, reinforcing existing divides in wealth and opportunity. The impact on local economies is visible in day-to-day life. Fewer full-time residents mean declining school enrollments and reduced funding for public services, but the cost of maintaining roads, emergency services, and infrastructure remains. Emergency response times increase as resources are stretched thin. Local businesses that once relied on year-round customers now depend on a seasonal influx, making it harder for workers to find stable employment or affordable housing. In some towns, new construction skews heavily toward luxury condos and high-end vacation rentals, with little added for local workers or young families. Maintenance patterns also shift in areas dominated by vacation homes. Inheritors spend less on upkeep than full-time residents, leading to slow but visible deterioration, aging roofs, peeling paint, and empty lots where lawns go untended. Code enforcement becomes more difficult when owners live out of state, and violations go unresolved for months. Municipalities attempt to respond with vacancy taxes or short-term rental restrictions, but enforcement is often limited and legal challenges are common. The rise of professional management companies and rental platforms has made the process even easier. Services now offer to handle every aspect of converting an inherited home into a vacation rental, from marketing to guest turnover, for a percentage of the income. Inheritors can generate steady revenue with little involvement, while local tenants and would-be buyers see their options dwindle. Some companies even specialize in inheritance transition, smoothing the process before probate is complete. Family trusts and inheritance structures reinforce the pattern. Many inherited vacation homes are placed in trusts that require them to be held for a set number of years, ensuring they remain out of the for-sale market for decades. This cycle repeats as properties are passed from one generation to the next, often with the expectation that they will continue to serve as seasonal homes or sources of rental income. The result is a housing market increasingly oriented toward the needs of seasonal visitors and investors, not local residents. The homes that once anchored communities now function as assets for a small group, while the people who keep those communities running struggle to find a place to live. This pattern isn't the product of a single policy or decision, but a series of incentives and market pressures that reward holding onto property rather than releasing it back into circulation. These pressures are reshaping not just the market for vacation homes, but also the broader expectations about how and when housing will become available. The idea that a wave of homes would return to the market as older owners moved or downsized has proven unreliable, leaving younger buyers waiting for opportunities that rarely materialize. The downsize that wasn't. For years, analysts expected that as baby boomers entered retirement, they would downsize en masse, freeing up millions of homes for younger families. That wave never arrived. By 2025, just over 1 in 5 boomers have moved to smaller homes, a figure that remains unchanged despite years of forecasts about a coming senior sell-off. Instead, the vast majority are staying put, and a notable minority are moving into luxury senior communities rather than freeing up the kinds of homes younger buyers need. The promise of a major inventory release has simply not materialized. The reasons behind this are both financial and emotional. Most boomers secured mortgage rates well below today's levels, often under 4%, making it far more affordable to stay than to move. For a retiree paying $1,200 per month on an old mortgage, trading up to a similar home at current rates could mean a payment that's more than double. On a fixed income, that kind of jump is out of the question. Add to that the deep emotional attachment many feel to their homes, the place where decades of memories were made, and the motivation to leave fades even further. Surveys show that over 3/4 of boomers plan to remain in their current homes as long as possible, and nearly as many describe their home as central to their identity. Medical advances have reduced the pressure to relocate for care. In-home healthcare, telehealth, and new home modification services mean that seniors can manage complex medical needs without moving to assisted living. Programs that bring hospital-level care into the home are now mainstream, and Medicare has expanded its coverage for these services. As a result, health crises that once forced a move now simply trigger a round of renovations or additional support, keeping homes off the market for longer. When boomers do decide to move, the downsizing process rarely benefits first-time buyers. The average downsizer is not moving into a modest bungalow or starter home. Instead, most seek properties only slightly smaller than what they already own, often targeting high-end condos or age-restricted communities with amenities. These properties are not designed for young families. They're built for comfort, security, and convenience, and they command high prices. In urban markets, downsizing boomers now make up a significant share of condo buyers, competing directly with younger adults for the same limited inventory. With many boomers able to pay cash, they routinely win bidding wars against buyers who rely on mortgages. Tax policy and local laws reinforce this inertia. States like California and Texas offer property tax freezes for seniors, making it financially risky to sell and move. A relocation could mean losing these protections and facing a much higher tax bill on a new property. Federal tax rules also allow for the deferral of capital gains through 1031 exchanges, giving owners even more incentive to hold onto investment properties or swap them for similar assets rather than sell outright. The impact of this stalled downsizing is wide-reaching. Neighborhoods with high concentrations of aging residents see slower turnover, fewer new businesses, and declining school enrollments. The shortage of available homes for younger families drives up prices and intensifies competition, making it even harder for first-time buyers to enter the market. Builders, seeing the demand for senior-oriented housing, have focused new construction on luxury retirement communities and large single-family homes, leaving starter homes in short supply. This dynamic creates a feedback loop. Boomers stay put because there are few appealing downsizing options, and builders avoid creating those options because senior homeowners aren't selling. Meanwhile, the lack of movement at the top of the market keeps the entire system gridlocked. The result is a persistent inventory shortage that locks out new buyers, delays family formation, and widens the wealth gap between generations. For many, the hope of moving up in the housing market is now tied to factors far beyond their control. Even those who save diligently and wait for the right opportunity find themselves competing in a market where available homes are scarce and prices remain high. And as the population ages, the pressure on the system only grows, with each year of delayed downsizing compounding the challenges for everyone else trying to buy. But the difficulties don't end with the lack of available homes. Even for those who manage to find a property, another major obstacle stands in the way of student loan hangover, one that has quietly reshaped now shapes the home buying journey for an entire generation. For millennials and Gen Z, the average student loan balance in 2025 stands at $38,375, with monthly payments around $536. This isn't just another bill, it's a persistent drag on every financial decision, especially when it comes to qualifying for a mortgage. Lenders count every dollar of student loan repayment against your debt-to-income ratio, which directly reduces the amount you can borrow. For many, the reality is stark. A student loan payment can shrink your approved mortgage by over $100,000, turning the dream of ownership into a distant goal. The timeline for saving a down payment stretches out even further under the weight of student debt. A graduate allocating a portion of their income to loans will take nearly twice as long to save the standard 12% down payment on a median-priced home. During those extra years, home prices continue to rise, often outpacing any progress made on savings. The target moves further away, and by the time many buyers are ready, the cost of entry has increased by tens of thousands of dollars. Student loans don't just delay homeownership, they also change the profile of who can buy. Data from the National Association of Realtors shows that nearly 43% of younger millennials have student loan debt, and those with balances above $30,000 are significantly less likely to own a home by age 40. Mortgage denials tied to student debt are common, even among applicants with strong credit and stable incomes. Automated underwriting systems often flag student loans as a higher risk than other types of debt, leading to more rejections or demands for larger down payments and co-signers. The timing of inheritance often fails to provide relief. Many millennials receive property or financial assets only after years of making student loan payments and delaying major life milestones. By the time an inheritance arrives, often in their 40s or 50s, the window for using it to secure a first home has narrowed. Some inherit homes they cannot afford to keep because their debt-to-income ratios are stretched thin, forcing quick sales that convert potential generational wealth into short-term cash. Family formation and economic mobility are both affected. Census data shows that millennials with student loans have fewer children, marry later, and are less likely to own homes by their late 30s. The impact ripples outward. School districts in college towns report enrollment declines that track closely with student debt burdens, and local economies lose out on the spending that comes with new homeowners. Delayed homeownership also means less time to build equity and less financial security later in life. Partial loan forgiveness has provided only temporary relief, with many borrowers facing unexpected tax bills on forgiven amounts in certain states. Some have had to dip into retirement savings to cover these costs, undermining long-term financial planning. Meanwhile, traditional pathways out of student debt, like employer repayment benefits or military service, have become less common and less generous since the pandemic. The rental market offers little escape. Student debt holders spend a higher share of their income on rent, often reaching the same thresholds that would disqualify them from a mortgage. This creates a cycle in which paying rent makes it harder to save, and the act of renting itself becomes a barrier to ownership. Property managers report higher lease renewal rates among renters with student debt, as fewer feel able to make the leap into homeownership. The psychological effect is just as real as the financial one. Many borrowers see homeownership as unattainable and stop trying to save altogether. Mortgage applications from student debt holders have dropped, and the expectation of rejection has become self-reinforcing. Even as some manage to buy later in life, they take on mortgages that extend into their 70s, pushing financial security further out of reach. Student loan debt doesn't just delay the timeline for buying a home, it changes the entire pathway. It alters where people live, when they start families, and how they build wealth. And as traditional home buying becomes less accessible, new trends are emerging in how inherited properties are handled, reshaping the housing market in ways that go beyond simple ownership. The Airbnb inheritance. A new pattern is emerging as inherited homes are increasingly converted into short-term rentals. In 2025, nearly 3 in 10 properties passed down to heirs are shifted directly into platforms like Airbnb, bypassing the traditional for-sale market. This change isn't incidental. Companies have made it easy for inheritors to turn a house into a source of income with little effort. Specialized inheritance concierge services now handle every aspect: marketing, cleaning, guest management, so heirs can start collecting rental income almost immediately, often before they've even set foot in the house themselves. Financial incentives drive this shift. Tax rules let heirs avoid capital gains taxes by holding on to inherited homes and using them as vacation rentals. At the same time, they can deduct a wide range of expenses associated with short-term letting, from repairs to management fees. This makes the prospect of selling less attractive compared to the steady cash flow of a rental. In popular tourist areas, the numbers are hard to ignore. A property that might fetch $2,800 a month as a long-term rental can bring in $3,500 a week during peak season as a short-term listing. For many inheritors, especially those unfamiliar with real estate, the decision is less about community needs and more about immediate returns. The consequences ripple through local markets. In resort towns and coastal communities, entire blocks now sit empty for much of the year. Local workers, teachers, nurses, restaurant staff are priced out, forced to commute long distances or share cramped rentals. School enrollment drops as fewer families can afford to stay. Meanwhile, businesses that once depended on steady, year-round customers now struggle to survive outside of the tourist season. The housing that once supported stable communities is increasingly reserved for vacationers, and the rhythms of local life are dictated by the ebb and flow of short-term guests. The rise of accidental landlords is another byproduct. Most heirs never plan to manage a rental property. They're drawn in by convenience, the promise of income, and often the advice of financial planners or property management firms. But this arrangement brings complications. Without professional experience, many new landlords struggle to maintain properties, leading to longer repair times and lower tenant satisfaction. In neighborhoods with a high concentration of short-term rentals, residents report more noise complaints, increased strain on local services, and a loss of the stable social fabric that once defined their communities. The impact extends beyond just the local economy. As more homes are removed from the pool of available properties, competition for the remaining inventory intensifies. Investors now base offers on projected rental income rather than residential value, pushing prices higher and making it even harder for first-time buyers to compete. Inheritors who convert homes into short-term rentals benefit from tax advantages and rising property values, while those without inherited assets are left to navigate an increasingly inaccessible market. Attempts to regulate this trend have met with limited success. Local governments introduce taxes, licensing requirements, and occupancy limits, but enforcement is difficult and often challenged in court. Some cities have tried mandating local representatives or restricting the number of short-term rentals per neighborhood, but these measures rarely keep pace with the creativity of platforms and property managers. Even when regulations succeed, the outcome is often a shift to other forms of investment, such as long-term corporate rentals, which still do not return homes to the pool of available properties for buyers. Technology has accelerated the process. Platforms now use data to identify likely inherited properties and target heirs with customized marketing before they have a chance to consider selling. Many inheritors, faced with complex estate decisions and a barrage of offers, opt for the path of least resistance. As a result, the market for starter homes contracts further, and the wealth gap widens between those who inherit property and those who do not. The broader effect is a housing market where homes are increasingly valued as short-term income generators rather than as places for families to live. The social and economic costs are visible in empty neighborhoods, declining school enrollments, and the erosion of community institutions. The financial logic that drives heirs to keep homes as rentals is reinforced by the tools and incentives provided by platforms and tax policy, making it unlikely that these properties will return to the for-sale market anytime soon. This approach to inherited real estate is only one part of a larger system that channels housing wealth upward, using legal and financial tools that keep properties moving further from the reach of first-time buyers. The 1031 exchange trickle-up. One of the most powerful tools available to those inheriting property is the 1031 exchange, a tax code provision that allows real estate owners to swap one property for another, deferring capital gains taxes along the way. In 2025, nearly a third of heirs use this mechanism, not just to preserve family wealth, but to turn inherited homes into larger, more lucrative real estate holdings. Instead of selling a modest house and paying taxes on any gains, heirs can exchange it for a higher value asset, often moving up the ladder from single-family homes to multifamily buildings or commercial spaces. The outcome is a steady shift of housing assets away from the residential market, as properties that once served as homes are repurposed for investment and income generation. IRS data shows a sharp rise in these exchanges since 2020, with inherited properties making up a growing share of all like-kind swaps. The financial logic is clear. Selling an inherited home after accounting for stepped-up basis might still mean a hefty tax bill, while exchanging it defers those taxes indefinitely. For families already familiar with real estate, this is a straightforward way to scale up. They can use the equity from a $500,000 inherited home to acquire a $1.2 million apartment building or a commercial property, generating more income and setting the stage for further exchanges down the line. Meanwhile, those new to real estate or without access to legal and financial guidance rarely benefit from these advantages. The pattern has ripple effects throughout the housing market. County records reveal that more than half of residential properties swapped through 1031 exchanges in recent years are converted into commercial spaces or high-end rentals. In cities like Phoenix and Atlanta, this trend explains a significant portion of the missing starter homes. Properties that would have filtered down to first-time buyers instead become dental offices, storage facilities, or luxury rentals. Once these homes are repurposed, zoning changes and commercial investments make it unlikely they'll return to the residential market. The supply of affordable homes contracts, and the remaining inventory becomes even more expensive and competitive. Family offices and high-net-worth investors have taken the strategy to another level. Internal reports show that more than 80% of inherited homes managed by these groups undergo 1031 exchanges, compared to less than a quarter among individual heirs. The difference comes down to scale and expertise. Family offices can bundle multiple inherited properties, trade up to larger commercial holdings, and use tax strategies to maximize returns. Their average exchange transaction is several times larger than what an individual can manage, and their portfolios diversify quickly as a result. This approach keeps homes out of circulation, concentrating ownership, and reducing opportunities for new buyers. Developers and builders have responded to these incentives by designing new homes with future exchanges in mind. Architectural plans increasingly include features that make conversion to commercial use easier: ADA-compliant entries, reinforced electrical systems, and flexible layouts. These upgrades add to construction costs, making new homes more expensive for buyers while appealing to investors who see long-term exchange value. The focus shifts from creating homes for families to building assets for eventual conversion and income generation. The financial sector has adapted as well. Lenders now offer specialized lines of credit for 1031 exchange participants, often at rates below those available to traditional homebuyers. Underwriting standards prioritize the value of the target property over the borrower's income, allowing inheritors to leverage their equity far beyond what a first-time buyer could access. This dynamic gives exchange users a permanent advantage in acquiring and scaling up their holdings, while buyers relying on conventional mortgages face stricter limits and higher costs. The effects extend beyond the housing market. When homes are exchanged into commercial properties, local tax revenues shift. Commercial spaces often generate less property tax per square foot than residential homes, but require similar infrastructure and public services. School districts and municipalities report budget shortfalls as the tax base erodes, even as population and service demands remain steady. Local businesses also feel the impact, as commercial rents rise to cover higher acquisition costs, squeezing out small operators and changing the character of neighborhoods. Each time a property moves through a 1031 exchange, the potential for it to serve as a family home diminishes. Over the next decade, demographers estimate that millions of homes will be lost to this process, not because they disappear, but because they are absorbed into commercial portfolios. The benefits of the 1031 exchange are clear for those who can access them, but the broader effect is a housing market where opportunities for ownership and stability are reserved for those with assets to begin with. These financial strategies don't just influence the fate of inherited homes. They intersect with the realities faced by families trying to care for older relatives, manage rising costs, and make tough decisions about whether to hold onto or sell family property. The caregiver squeeze. The pressures of caregiving have become a defining force in the housing market. Adult children responsible for aging. Parents must navigate a landscape where the cost of care outpaces not only their incomes, but the value of the homes they might one day inherit. With the median annual price of a nursing home now at $108,000, a family home, often valued around $420,000, can be drained in just a few years. Instead of serving as a nest egg for the next generation, the house becomes a financial lifeline for covering medical bills, long-term care, and assisted living costs. This squeeze leaves caregivers facing harsh decisions. More than 1 in 10 American adults now provide regular care for another adult. Many reduce their work hours or leave jobs entirely, sacrificing career advancement and income. At the same time, they are expected to keep up with their own rising housing expenses. Mortgage payments for first-time buyers now stretch well into what should be retirement years, and saving for the future becomes nearly impossible when so much is devoted to a parent's care. The financial strain doesn't end with lost wages. Caregivers who tap into retirement accounts to pay for care find their own home buying prospects diminished, as every withdrawal reduces their mortgage qualification. The structure of the elder care industry compounds these challenges. Private equity firms now control a growing share of nursing homes and assisted living facilities, driving up prices and pushing families to sell assets quickly to keep up with rate increases. Stories of rushed home sales are common, with families accepting lower offers from institutional buyers just to secure a place for a parent. The proceeds that could have built wealth for the next generation are instead funneled into a system where quality care depends on the ability to pay, and where the value of a family home can be consumed in a handful of years. The shortage of accessible housing only makes things harder. Less than 5% of homes in the U.S. have features like step-free entries or widened doorways. Retrofitting a house for aging in place is expensive. Installing a stair lift, widening doors, or adding ramps can cost tens of thousands of dollars. For seniors on fixed incomes, these costs are often out of reach. Many end up choosing between expensive institutional care and equally costly home modifications, with neither option leaving much for heirs. Caregivers also face the reality that the timing of these expenses couldn't be worse. As home prices and mortgage rates remain high, many are forced to divert savings that could have gone toward down payments or retirement. The median age of first-time buyers has risen to 38, and those who care for parents often delay buying even longer. Each year spent supporting an aging parent means another year of rising home prices and lost equity-building potential. The financial hit compounds. Caregivers earn less during their peak earning years and watch as home values climb out of reach. Even when families try to keep homes in the family, reverse mortgages and outstanding debts often force quick sales. Lenders require repayment within months of the borrower's death, and most heirs cannot afford to cover the balance or maintain the property. The majority of these homes end up sold below market value to investors, who convert them into rentals. The opportunity for intergenerational wealth transfer is lost, and the cycle continues. Homes that could have anchored families instead become income streams for corporations. Municipalities feel the impact too. When homes are sold to cover care costs, they often transition to rental or commercial use, shrinking the residential tax base. School districts see declining enrollments as families delay having children or move away, and neighborhoods lose the stability that comes from long-term homeownership. The effects ripple outward, changing the makeup of entire communities. The caregiver squeeze is more than a personal hardship. It's a structural force reshaping how, when, and whether homes are passed from one generation to the next. But the challenges don't stop at the family level. Where these homes are located, and whether they match the needs of younger buyers, adds another layer of complexity to the housing market's ongoing transformation. The geographic mismatch. Inherited property often lands in places far removed from the economic centers where demand is highest. The mismatch between where homes become available and where younger buyers want to live is one of the most persistent obstacles in today's market. In 2025, over 60% of inherited homes are located in counties with shrinking job markets and declining populations. These are not the vibrant cities or suburbs with growing industries and public amenities. but aging towns and rural areas where opportunities are limited and infrastructure lags behind. The typical inherited home is valued at $289,000, well below the national average, not because of its size or features, but because its location offers little appeal to those building careers or raising families. The Sun Belt's retirement enclaves make the problem visible. Developments in Arizona and Florida, once magnets for older homeowners, now report vacancy rates above 15%. Heirs inherit condos and single-family homes in these communities, but have little use for them, leading to quick sales at reduced prices. In 2025, more than 40% of inherited Sun Belt homes are sold for less than their inflation-adjusted 2020 values. As demand dries up, listing prices fall year after year, and the cycle deepens. Fewer buyers, more vacant homes, and further price erosion. Meanwhile, the cities and regions with strong job growth see almost none of the supposed inventory boost from generational turnover. In places like Seattle and Boston, inherited homes make up just a small fraction of listings, unchanged from previous years. Properties that do pass down in these markets are more likely to be kept as rentals, not sold to new families. In high-demand neighborhoods, heirs often choose steady rental income over a sale, locking up homes that might otherwise help ease tight supply. Research from Cambridge shows that over 80% of inherited homes near major universities are converted to rentals, not owner-occupied housing. The speed of sales in struggling markets is another sign of the disconnect. Heirs who receive property in towns with weak economies know that waiting means losing value. On average, these homes spend nearly a month less on the market than comparable properties in healthier regions, as sellers rush to offload them before prices drop further. Investors, rather than families, are the most frequent buyers, adding to the pool of rental stock and reducing the number of homes available for owner-occupants. Infrastructure gaps add to the challenge. Nearly 3/4 of inherited homes are more than 15 miles from reliable public transit, making them impractical for commuters. Access to modern amenities is limited. Only a small percentage of these properties are in areas with widespread electric vehicle charging or high-speed internet. For many inheritors, the costs of upgrading a property or adapting to a slower local economy outweigh any sentimental value, making a quick sale the only practical option. School quality and local services further shape decisions. Inherited homes are more likely to be located in districts with declining enrollments and lower performance metrics. Young families, already hesitant to move to areas with few job prospects, avoid these regions, reinforcing a cycle of shrinking populations and falling property values. The average inherited home in a low-performing school district loses value each year, while homes in top districts continue to appreciate. The type of housing also matters. Most inherited properties are older, detached houses built decades ago. Younger buyers increasingly prefer attached homes, condos, or new builds with energy-efficient features and flexible layouts. Even when location is not a deal-breaker, the mismatch in housing style and condition creates another barrier to occupancy. Deferred maintenance is common. Older homes often require substantial repairs, and the costs are rarely justified by the potential return. Climate risks and insurance costs add another layer of complexity. A significant share of inherited homes are located in flood zones or regions with high wildfire risk. Insurance premiums in these areas are rising sharply, sometimes exceeding $5,000 a year, turning what could be an asset into a liability. Many heirs find themselves unable to sell at all, as buyers are unwilling to take on the financial risks. The economic consequences are visible in local communities. Towns with large stocks of inherited and unsold homes see fewer new businesses, shrinking tax bases, and declining services. Bank closures and the loss of healthcare providers follow, as populations age and young families look elsewhere. Attempts to attract remote workers often fail due to gaps in broadband access and limited infrastructure investment. The geographic mismatch between where homes are inherited and where buyers want to live ensures that the wealth transfer many hoped for fails to materialize in any meaningful way. Instead of bridging generational divides, it often leaves inheritors with properties they cannot use and buyers with nothing available where they need it most. This divide is not only about geography. It is reinforced by the ways families now structure inheritances, the trust separating those with access to housing. A new layer of complexity has emerged in the way property is passed between generations. the trust fund bypass. Instead of transferring homes directly to heirs, affluent families increasingly use legal structures like irrevocable trusts to keep assets under tight control for decades. These arrangements don't just delay inheritance, they fundamentally reshape who can access property, when and under what conditions. For many beneficiaries, the promise of a family home remains theoretical until well into middle age, long after the years when it could have changed the trajectory of their lives. Trusts now play an outsized role in the housing market. Dynasty trusts, for example, control a growing share of single-family rentals, locking properties away with strict rules on when and how they can be sold or occupied. A property placed in trust today might not be accessible to its intended beneficiary until that person is in their 50s. The result is a housing inventory that exists on paper but is functionally frozen, unavailable for first-time buyers, unresponsive to local needs, and managed primarily for long-term appreciation and income. These homes don't cycle through families or neighborhoods. They remain assets for balance sheets, not places for people to live. The timing is rarely advantageous for the next generation. Most trust beneficiaries gain access to property decades after the point when it could help them buy a first home, raise a family, or weather financial shocks. By the time they inherit, the property's practical value often diminishes. It might be in a location they have no connection to, or require costly updates to meet their needs. In the meantime, these homes are typically managed by professional firms, rented out to maximize income for the trust, with little incentive to maintain community ties or invest in local infrastructure. Financial engineering drives these choices. Trusts are designed to minimize taxes and shield assets from creditors. Stepped-up basis rules mean that when a trust eventually transfers ownership, heirs avoid capital gains taxes on decades of appreciation. 1031 exchanges allow properties to be swapped for higher-value real estate without triggering a tax bill, and some states cap property tax increases for trust-held properties, further encouraging long-term holding. Over time, this creates a cycle where homes are rarely sold, rarely occupied by owners, and steadily accumulate value for a small group of beneficiaries. The scale of this strategy is significant. Families employing trust structures often hold multiple properties, using rental income to fund trust administration and future acquisitions. Their heirs enter later life with a portfolio of valuable assets, while others struggle to secure a single home. Data shows that middle-aged buyers from trust families are far more likely to make all-cash offers, further outcompeting peers who rely on conventional financing. The advantage is not the result of luck or hard work, but of a system designed to perpetuate wealth and restrict access. Communities feel the impact. Trust-owned homes generate less local spending than owner-occupied properties, and their tenants, often short-term or transient renters, are less likely to participate in schools or civic organizations. Over time, neighborhoods dominated by trust holdings see lower rates of community engagement and declining support for public services. The properties themselves are more likely to fall into disrepair, as no individual owner feels responsible for upkeep. Deferred maintenance becomes common, and when trusts finally transfer ownership, the costs of bringing a home up to standard can be substantial. The legal and financial barriers to challenging these structures are high. Trust terms are enforced through binding arbitration, and legal challenges are prohibitively expensive, with little chance of success. The system is self-reinforcing, operating beyond the reach of most policy interventions. Even proposed reforms, like taxing dormant properties or limiting trust durations, face significant legal opposition and have yet to gain traction. The result is a housing market where opportunity is increasingly determined by access to complex legal and financial tools. Properties that could have housed multiple families over the course of a generation instead remain locked away, contributing to persistent shortages and rising prices. The gap between those with access to trust-held assets and those without continues to widen, not just in wealth, but in the ability to participate in stable, long-term homeownership. These dynamics are not just quirks of estate planning. They are central to understanding why the so-called Great Wealth Transfer has yet to deliver meaningful change for most would-be buyers. As the next generation waits for access that may never come, the broader promise of shared prosperity in the housing market remains out of reach. Looking at the numbers, the Great Wealth Transfer is underway, but its impact on housing is not what many hoped. While $105 trillion is expected to move to heirs by 2048, most of that wealth will flow to the top 10%, deepening existing divides. For average buyers, the effect is minimal. Homes that could serve as entry points into ownership are increasingly held as rentals, vacation properties, or locked in trusts. Prices remain high, inventory stays tight, and the same families continue to benefit. The rules of the market aren't opening new doors, they're reinforcing old barriers. For those without inherited assets, the path to ownership grows narrower, and the system keeps favoring those already inside.